Let us start with one sum on dissolution of a partnership firm wherein we are required to apply the principle of Garner versus Murray. Please read the sum on the screen. I read for you. Shakti, Bhakti and Mukti are the partners in a firm sharing profits and losses in the ratio of 2:2:1 respectively. The balance sheet of the firm as on 31/3/2010 is as under. This is the liability side, this is the asset side. On liability side, you are given the capital of Shakti, Bhakti, Mukti, general reserve, bank loan and creditors. On asset side, you are given the details of building, machinery, stock, debtors/bad debt reserve, cash and bank balance and profit and loss account. The firm was dissolved on the above date. The information relating to the dissolution has been obtained as under. Shakti has taken the stock at a price of 15,000. Journal entry for that is Shakti's capital account debit to realization account credit. While Bhakti has taken the building at a price of 65,000, Bhakti is the receiver. Bhakti's account debit to realization account credit 65,000. 28,000 will be recovered from debtors in full settlement. Cash or bank account debit 28,000 to realization account credit 28,000. Machinery realized 5,000 less. Machinery is 25,000, 5,000 less. So cash received for machinery is 20,000. Cash or bank account debit to realization account credit. That's the entry for value realized for machinery, which is 5,000 less than the book value. Bank loan has been paid along with accrued interest 5,000. Bank loan is 35,000. So you have paid 35,000. Journal entry for that is what? Realization account debit to cash account debit 35,000. This is the principal sum paid. Now we have to pay interest. Same entry. Realization account debit to cash or bank account debit 5,000. Creditors have been paid as per book value. Look at the creditors are 40,000. They are paid book value. So they are paid 40,000. What's the entry? Realization account debit to cash or bank account debit. Now see. An unrecorded liability of 12,000 has been settled by Shakti by making a payment of 10,000 in full settlement. So liability is assumed by a partner. When partner assumes a liability to the firm, partner is a giver. Partner's capital account is to be credited. And settlement of liability is always debited to realization account. So the journal entry for that is realization account debit 10,000 to Shakti's capital account credit 10,000. This is the entry that gets recorded. That is the value agreed 10,000. 10,000 should be recorded, not 12,000. Bhakti is accepted to bear the entire expenses relating to dissolution, for which he is paid rupees 3,000. Now, the dissolution expense responsibility is taken by a partner for which 3,000 payment is committed. Then firm never bothers what amount the partner has spent for that. So the payment made by the firm is relevant, that is 3,000. Journal entry for that is realization account debit to Bhakti's capital account credit. Mukti was declared insolvent and 1,000 only could be recovered from the personal assets. Now one of the partner is insolvent. One of the partner is insolvent and only 1,000 could be recovered from the assets. From the above information prepared, as per Garner versus Decision, realization account, partner's capital account, cash and bank account. So we are required to apply the Garner versus Murray's decision. What is Garner versus Murray's decision? See, this decision can be applied when one of the partners is insolvent. Second, amount recoverable from such partner could not be recovered. Third, this loss is known as capital deficit or capital deficiency. This capital deficiency is not a trading or a business loss. So it cannot be distributed in the profit sharing ratio, that is 2:2:1. Then in which proportion such capital deficit loss should be distributed? As per Garner versus Moore's decision, it was announced that such capital deficit that has arisen because of the insolvency of a partner should be distributed amongst solvent partners in the ratio of their capital existed on the date of dissolution. So we are required to find out the capital balance as on the date of dissolution of solvent partners. That we shall work out immediately after copy the balance sheet. And in that ratio, whatever the capital deficit that we work out for Mukti's insolvency or Mukti's insolvency will be distributed in that capital proportion. One more thing that was suggested by Garner versus Moore's decision was that the solvent partners are supposed to bring cash equivalent to the realization loss suffered by them. That is also important point we are going to consider while solving this sum. Now let us start with the sum. First of all, let me prepare the various accounts. Here I have prepared realization account. This is partner's capital account. This is cash and bank account. This is my balance sheet. Now first step for the purpose of solving the sum is to consider the details of balance sheet. How to consider assets to be realized are debited to realization account, liabilities to be settled are credited to realization account, capital balances are transferred to capital account, undistributed profits and losses are distributed amongst partners, cash and bank balances recorded in the respective cash and bank account. Now let us start with that. See, building on asset side is 70,000, that is debited to realization account. Machinery 25,000 debited to realization account. Stock 20,000, that is also debited to realization account. Debtors 32,000 debited to realization account. Banded reserve credited to realization account. Cash and bank balance is recorded as opening balance. Profit and loss account, debit balance 45,000. Now see this profit and loss account, debit balance 45,000. This 45,000 debit balance of profit and loss account should be distributed amongst partners in the ratio of their profit sharing, because this is an undistributed loss and that requires to be distributed amongst partners at the instance of dissolution. So 45,000 will be distributed amongst partners in the ratio of 2:2:1. That is the profit sharing ratio. See, the profit sharing ratio of partner is 2:2:1. If 45,000 is distributed in the ratio of 2:2:1, 45,000 divided by 5, 9,000, 9 2s are 18,000, 18,000 and 9,000 is the distribution. So 18,000 is the share of Shakti in loss, 18,000 is the share of Bhakti in the loss, and 9,000 is the share of Mukti in loss. The journal entry for this distribution of this loss is profit and loss account debit to Shakti capital account credit, right? No, losses are always debited to the partner's capital account. So Shakti's capital account debit, Bhakti's capital account debit, Mukti's capital account debit to profit and loss account credit. Notice the posting that I need for you. 45,000 is distributed between Shakti, Bhakti and Mukti. 18,000 debited to Shakti's capital account, 18,000 debited to Bhakti's capital account, and 9,000 is debited to Mukti's capital account. Notice journal entry for that is Shakti's capital account debit 18,000, Bhakti's capital account debit 18,000, Mukti's capital account debit 9,000, to profit and loss account credit 45,000. Now this is how the asset side is considered. Now I want to consider the liability side. Capital of Shakti credited to Shakti's capital account, capital of Bhakti credited to Bhakti's capital account, capital of Mukti credited to Mukti's capital account. General reserve is also 15,000, general reserve 15,000 is also undistributed profit. That profit is required to be distributed in the ratio of 2:2:1. 15,000 divided by 5, 3,000. 6,000 is the share of Shakti, 6,000 is the share of Bhakti in the general reserve, and 3,000 is the share of Mukti. 6 plus 6, 6 plus 6 plus 3, that makes 15,000. So this 15,000 distributed amongst partners in the ratio of 3:2:2:1. Journal entry for that is general reserve account debit 15,000 to Shakti's capital account credit 6,000, Bhakti's capital account credit 6,000 and Mukti's capital account credit 3,000. This is how general reserve is distributed amongst partners. Now bank loan transfer to the credit side of realization account and creditors also transfer to the credit side of realization account. This is how the balance sheet details are considered for solving the sum on dissolution. Now the next step. The next step is to find out the capital ratio of solvent partners, because in that ratio we are going to distribute the capital deficit of an insolvent partner. Notice that in this sum, Mukti is an insolvent partner. So Mukti is insolvent, so Shakti and Bhakti are solvent partners. Let us find out the capital proportion of Shakti and Bhakti as on the date of dissolution. Look at this working note that I prepare. Total, the credit amount of Shakti's capital account, that is 57,000 plus 6,000. From that deduct this 18,000. So you will get the capital balance of Shakti as on the date of dissolution, 45,000. Now same way another solvent partner is Bhakti, 42,000 plus 6,000 minus 18,000. So the capital balance of Bhakti on the date of dissolution is 30,000. So 45,000 is to 30,000 is the capital ratio of the solvent partners as on the date of dissolution. 45 is to 30, that is 3 is to 2. So 3 is to 2 is the capital ratio. In this ratio, the capital deficit of an insolvent partner will be distributed at the end. After preparing this working note about the capital ratio of solvent partners, let us start with the next step, is to realize the asset. Now, the information given to us for realization of assets and settlement of liability, that we shall consider one by one. Shakti has taken the stock at a price of 15,000. Bhakti has taken the building at a price of 65,000. Here Shakti is the receiver, 15,000. Shakti's capital account debit to realization account credit. Instead of Shakti, I write as capital account. Abbreviation, just tolerate it. Bhakti has taken the building for 65,000. Bhakti's capital account debit to realization account credit. Out of all these assets, stock and building has been realized. Next, rupees 28,000 to be recovered from debtors. So cash account debit to realization account credit. And machinery realized 5,000 less. So value of machinery is 25,000, 5,000 less, 20,000 is realized. Entry same, cash or bank account debit to realization account credit, 20,000, realization account credit, 20,000. Cash or bank account debit to realization account credit, machinery realized 20,000 rupees, which is 5,000 less than the book value, that is 25,000. Now next, bank loan has been paid along with interest 5,000, so bank loan is paid and interest is paid. Bank loan is 35,000, payment of bank loan, realization account debit to cash or bank account credit. So bank loan paid 35,000. Over and above this 35,000, we are required to pay interest 5,000, same is the entry. Realization account debit to cash or bank account credit, interest paid for 5,000. Creditors are paid as per book value. Creditors are 40,000, so creditors are paid 40,000. Journal entry same. Realization account debit to cash and bank account credit. Payments are always credited to cash and bank account. And here the liabilities are settled. The value settled for the liability is always debited to realization account. So entry for payment to creditors, realization account debit to cash account credit. This is how this 1, 2, 3 information is taken care of. Now next, An unrecorded liability of 12,000 has been settled by Shakti, making a payment of 10,000. Now liability of a firm paid by a partner. Partner is a giver to a firm. Partner's capital account is to be credited. And unrecorded liability settled has to be debited to realization account. Which value should I record? 12 or 10? 10,000 is the amount paid by the partner is to be considered. Journal entry for that is realization account debit to Shakti's capital account credit 10,000. Unrecorded liability paid by a partner. Realization account debit to partner's capital account credit. Now next, Bhakti has accepted to bear the expenses relating to dissolution for which payment made 3,000. The actual dissolution expenses amounted to 2,500. That information is not relevant to the firm. When firm pays the amount agreed, accounting of the firm is over. So 3,000 paid for dissolution expenses to partner, realization account debit to partner's capital account credit. So realization account debit to Bhakti's capital account credit 3,000. Firm committed to pay Bhakti 3,000 for conducting the dissolution affairs, and for that payment accepted agreed is 3,000. Realization account debit to Bhakti's capital account credit. The actual expenses amounted to 2,500. That matter is not relevant. Now, assets and liabilities are realized. Now let us find out the profit or loss on realization of assets and liabilities. Total of debit side is 2,40,000. From that, amount credited to realization account gets deducted, that is 77,000, 15,000, 65,000 and 48,000. Here you will get the realization loss, and whatever the realization loss that you get, it should be distributed amongst partners in the ratio of profit sharing, that is 2:2:1. So 24,000 minus all these things, so 35,000 is the loss, distributed in the ratio of 2:2:1. 7 5s are 35, 7 2s are 14, 14,000, 14,000 and 7,000 is the loss to be suffered by the partners. That will be debited to the partner's capital account. And the solvent partners are supposed to bring cash equal to the realization loss suffered by them. That is the pronouncement of Garner versus Moore's decision. So this 35,000 distributed in the ratio of 2:2:1, 14,000, 14,000 and 7,000. As capital account will be debited, Bhakti's capital account will be debited, Mukti's capital account will be debited. So 14,000 Shakti's capital account debit, 14,000 Bhakti's capital account debit, and 7,000 Mukti's capital account debit to realization account credit 35,000. Now Shakti and Bhakti are the solvent partners. They have to bring cash equal to realization loss sustained by them. So cash account debit to Shakti's capital account credit 14,000, and same entry we are supposed to write for Bhakti. Bhakti also brings 14,000. Her share in realization loss brought in cash by Bhakti. So cash account debit 14,000 to Bhakti's capital account credit 14,000. Now, Mukti is an insolvent partner. She brings only 1,000 rupees. Though loss to her share is 7,000, she is insolvent, she is unable to pay her obligations. Whatever the amount she brings, we should write down. Cash account debit to Mukti's capital account credit 1,000. Now, after recording all these things, we should find out the capital deficit of an insolvent partner. Let us prepare the working note for that. Mukti is an insolvent partner. Whatever the capital deficit is there, that is going to be distributed between solvent partners in the ratio of capital. And we have already worked out the ratio of capital. This is the ratio of capital that we have worked out initially. Now let us find out the capital deficit of an insolvent partner. Total of debit 9 plus 7, 16,000. Total of debit side. Total of credit side is 11 plus 3, 14. Amount due from Mukti was 2,000. Again that she brings only 1,000. So the capital deficit 1,000, which you could not bring, that will be distributed between Shakti and Bhakti in the ratio of 3:2. So 1000 into 3 by 5 share of Shakti and 1000 into 2 by 5 is the share of Bhakti. This is 600 and 400 is the capital loss that is borne by solvent partner Shakti and Bhakti. When partner suffers loss, Shakti and Bhakti's capital account is to be debited and Mukti's capital account gets credited for the 600 plus 400, 1000 capital deficit. By crediting this 1000 capital deficit, what happens? Mukti's capital account gets closed. So here, Shakti's capital account debit to Mukti's capital account credit. Loss suffered by Shakti because of the insolvency of Mukti. Loss suffered by Bhakti, Bhakti's capital account debit to Mukti's capital account credit 400. Loss suffered by Bhakti because of the insolvency of Mukti. So the journal entry for that is Shakti's capital account debit 600, Bhakti's capital account debit 400 to Mukti's capital account credit 1000. Now capital deficit is distributed. By this distribution, the Mukti's capital account gets closed. 16,000 is the total of both the sides. Now if we should find the redeemable capital of Shakti and Bhakti, total of Shakti's capital account credit side is 87,000. From that, 18,000, 15,000, 14,000 and 6,000 will be deducted. So you will get the capital redeemable to Shakti. But in case of Bhakti, she is an insolvent partner. But amount to the debit side of Bhakti's capital account is more than the credit because 65,000 is the value of building that Bhakti has taken. So here the amount is not redeemable to Bhakti, but amount is recoverable from Bhakti and she is a solvent partner. She will bring the debit balance standing to her account. While in case of Shakti there is a credit balance, so Shakti will be paid and Bhakti has to contribute for the payment. So 39,400 is to be paid to Shakti. Shakti's capital account debit to cash account credit. But the cash is short to make this payment because Bhakti is required to contribute. Now total of debit side of Bhakti's capital account is 97,400, 18,000 plus 65,000 plus 14,000 plus 400 minus this credit, so difference is 32,400. So Bhakti is required to bring 32,400 in the form. If she brings it, by her bringing 32,400, we can make the payment to Shakti 39,400. Bhakti is a solvent partner. She brings the debit balance standing to her account. The debit balance standing to her account is 32,400. That she brings cash account debit 32,400 to Bhakti's capital account debit 32,400. Capital accounts are closed. Now I want to close cash account. Total on both the sides of cash account should agree. Total of debit and total of credit if you make, it should be 1,19,400. This 1,19,400, this total also should be 1,19,400. This is our cash account should agree. No cash balance should be left. And if no cash balance is left, that is the sign that our accounting is true and the dissolution accounting is over. I think you must have followed this one. Thanks to all of you.